Hello and welcome to The Banker. My name is Silvia Pavoni. I'm the economics editor of The Banker, and I'm talking to Michael Sullivan, who is the CIO for EMEA at Credit Suisse. Michael, thank you for joining me.
Thank you, Silvia.
So when we agreed to meet and have a little chat about mega trends for this year, that time was before the events of this weekend, which involved the Swiss franc. So perhaps we should start with this and what this means for the FX markets and for the banking sector in general.
And I guess not just the Swiss National Bank. I mean, as a sort of an opening comment, one thing I would say, and that maybe grips me as being the most important new trend, is that in the last 2 years we've had an environment of what I would call volatility suppression, where liquidity from central banks has kept volatility low. And since October, I think that's changing. We are potentially entering into a much higher volatile regime. And then, of course, some of that is being spurred by the pressures that are on central bankers. If I step back and look at Switzerland, I think Switzerland as a small country is a good example of a kind of a canary in the coal mine of the world economy. Because many of the pressures that were acting on the Swiss franc are a result of the ailments of other economies, the Eurozone, for example, Russia on the other hand. And the Swiss franc, if you like, was a kind of a magnet that attracted flows from these areas. And that support broke last week.
So this is pretty worrying, because if this is just a little taste of things to come, things can become quite difficult to manage. Where would you imagine a similar situation erupting next?
Well, we've had a very similar situation with OPEC. OPEC, if you like, is the keeper or the guardian of the price of oil. And it has talked the price of oil downwards, but maybe the last month or so of that fall has become more and more chaotic. There are signs now, I think, that oil is beginning to stabilise at a much lower level, well over 50% below where it was this time last year.
A massive drop, which is on one hand positive for consumers, but on the other hand not so good for governments. What does it mean for banks?
That's true. I think for banks specifically it means this environment of low interest rates continues, and that this environment of, optically at least, deflation or disinflation continues as well.
You mentioned obviously the Eurozone. What are your views for this year? Are things going to, is growth going to come back somewhere, at least in the Eurozone? And are you hopeful about the ECB new, stronger role?
I do think growth will come back in the Eurozone, albeit slowly. And amidst the debate in QE, some of the macro indicators are beginning to turn up. I'm not convinced that QE is the answer to the Eurozone's problems, but it does provide a necessary tonic or anaesthetic while some of the other medicine is digested, as it were. And I think the ECB will begin QE at the January meeting. I think a lot of that has been telegraphed already. What for me is more interesting is what the European governments do for the rest of this year.
Very good. So we touched on a few very important topics, but we should meet up in a few months and see how these issues are developing. Thank you again for joining.
Thank you.
Thank you.